Jonathan Tuttle, welcome to the REI Diamond Show. How are you today?
Good. Thanks for having me on. Excited to be here.
Yeah, we normally do a little bit of a location stamp. So I'm in Chicago right now. I'll spend the winters in Florida. That's the extent of my nomading. And we've had one other guest who's going to give us an answer, I think, like you're going to give us here today. A guy who was kind of like living in Vietnam and maybe not as Tim Ferrissy as you're about to say. So would
Yeah.
you mind kind of giving us the location stamp and sort of what your plans have been, lately and in the next year?
Yeah, I've been doing the whole digital nomad and then come back for conferences, specifically like family office and private equity conferences. Most of this year I've been Southeast Asia, actually entire year. Bali, uh, Bangkok, just a lot of Singapore, Hong Kong. Now I'm going to be back on this side of the world, basically. So a lot of the Dominican Republic, Costa Rica for a while, Nicaragua before Miami. So that's the rest of the year. And I'll be speaking next week in Nashville at the private equity conference. So basically, my schedule is always planned out 4 or 5 months in advance. So it becomes like a routine.
Yeah, it's interesting that we have the opportunity to live a life like this in this digital age with that kind of flexibility and freedom of location. So that's cool. Cool. As we jump in here, Jonathan, you've got an interesting story how you landed in real estate. I will let you go as deep or wide or narrow and shallow as you might like to go on the stuff outside of real estate here.
Okay.
But what I do want you to cap off there is sort of the evolution into the flex space because I
Okay.
think that's relevant right now and it's a hot topic. It's a hot asset class that I believe we're in the middle of an event, 3 to 5 year runway where that starts to get super heated. So if you could kind of finish there with your intro, that'd be great.
Sure. No, that's actually it's a great observation. It's 100% correct. Grew up in a real estate developer family. My dad was a GC, built single family, not commercial. 75 plus custom homes over like 30 years. Actually, most of us done the 90s. That was like the big boom. Suburbs of Chicago, so right in your backyard. Uh, Aurora, Yorkville, those were like the fast DuPage County areas were like with the fast growing markets back in the 90s if you're from Chicago. Um, yeah, and then just segue that into I actually worked in Chicago got my start in commercial real estate with Sperry Van Ness. It's called SVN now, but Sperry Van Ness on the brokerage side, and then started focusing on the mobile home parks sector because that's what we were also investing in at the same time. My dad was also investing in mobile home parks. Saw how that really did extraordinarily well in the last downturn when everything else, all the other real estate asset classes were having issues. And that was kind of like right in the beginning of like the transition into private equity getting into the space in the 2010s. But then after that, started just focusing more on the investment side of it. And so part of one of the things we're doing now is really is the opportunities we talked about beforehand. The mobile home park space is about 43,000-ish parks. It's not, there's a lot of institutional players in the space now. The deals are far and few between as they were. They're not as frothy as they were 10 years ago. And so with the real opportunity where, which you alluded to is it's flex space for us specifically reminds me of like what you mentioned 10, 12, 15 years ago, mobile home park self-storage at that point, where it was like before the institutional was still underserved, the markets needed it. And so we're focusing on the highest growth states right now, which specifically is Texas. We're 8 out of 10 fastest growing markets in the states. And we've acquired some pretty good prime locations on I-35 and in around Austin, San Antonio area. So that's kind of where my real estate story evolved.
Perfect. I love it. Let's for the listener define flex space, right? It's kind of industrial, it's kind of small, but like what would you put as very specific definitions of what that is?
Yeah, no, I mean, it's yeah, it's like the name kind of implies itself. It's basically I say it's kind of like land with like a self-storage type container on it typically. And you could have self-storage on it, but it's built out mainly for you think of like e-com stores, if people because e-commerce is really big right now. They have their own brands, but also the biggest clientele is going to be HVAC plumbing, small manufacturing. And it's usually those guys that, they want to put the money back into their business, their trucks, and they just want to have a prime location off a major road for some signage. and also close proximity to, who the actual, tenants and clients would be. And so it's just basically more like, just think of like a self-storage type, but bigger building, but just mainly very basic bare bones. And it's mainly just to store stuff. And like, so it's reminds me of like, basically reminds me of self-storage, but for holding commercial assets and having a little, most tenants typically just have a small little office with a little AC in it, and that's it, or HVAC in it. And it's basically mainly for serving that specific need of audience. And right now, as we know, with a lot of people, with everything going to AI, HVAC and plumbing is still like an industry that's going to be resilient for the next 5 to 10 years. You're seeing a lot of private equity guys really trying to roll them up too, because it's so resilient and you can't replace it with robots. So we like to look at the trends of where people are going and what's the market's needs are, and trying to find like our little pocket and niche where other people are, and it's not super competitive.
Yeah, so if we put like a square footage size, what would be the size of each unit in the building that you're working on developing now?
Yeah, the one right now we're doing seven, it's a two-phase, 84,000 square feet. And we got a couple others. We have the second one already, 100,000 square feet. But typically we look for between 50 and 100,000. It's kind of like with self-storage. I mean, people self-storage, you want to be around the 80,000. It's kind of similar dynamic to that.
Yeah. What are the size of each bay?
Well, we just put up the signs yesterday for leasing. So there's a new development on this one currently. So it's going to be flexible based on the tenant basically.
Okay.
So
All
we
right. So
literally just put the signs up yesterday.
you'll
But
start with an 84,000 square foot basically footprint envelope shell.
yep,
And then if a tenant needs 30, that's part of
exactly.
maybe why we're calling it flex. If they need, I don't know, if they need 2,000, is that
It would
like,
probably be too small. And we have like the top leasing broker in that area. I think to make it sense, I don't think anything under like 10 to 15,000 would
okay,
be.
perfect. Yeah, that's what I was looking for there because we have, I think I'm looking at actually a deal brought to me by a listener of the podcast, and I think the units are probably 2 to 3,000 square feet. And I have another friend, Saul, a Chicago guy as well, and he's buying stuff that is about that same thing, 1,000, 1,500, 2,000, and it's too small for the institutional buyer.
Yeah.
You can't really build it that small. It's like really expensive, like 130, 140 a foot by the time you put the HVAC and small office and a bathroom in each one. It's kind of like building friggin' multifamily. It's like not economically feasible anymore. So it's interesting to hear that the ones that you're building are in this 10 to 15,000 square foot range. So you might end up with, I don't know, 5 to 7 tenants in that building if you had to guess.
Yep. Yeah. And ultimately the play is a 2-year play. We're looking to sell it back as condos to the owners.
Okay. Now, you will lease those units up front first, or will there be
Yep.
like a lease and an option on day one?
Yeah. Both. Lease up front and with the option of, first right of refusal to prep the rent.
Okay.
And ultimately, we think they'll be the most interested, but also the private equity guys will like scoop it up. Because right now, like for example, we're on the market we're in is the second fastest growing market in the country. There's 3.5 billion with the states putting in between San Antonio and Austin and the infrastructure of the highway, about 110,000 vehicles per day. There's 10,000 brand new homes being developed across the street. And then there's also an $18 million Top Golf being built right down the corner, and a bunch of national retailers. I think even a Portillo's coming down there too. And if we're talking
Nice.
Chicago, I think even a Portillo's is coming down there too. So like everyone's going there. And so it's just like we're just like at the beginning of the rush. Like even when we acquired it, it's already worth like 1.2 more than what we just acquired it from. So
I have a buddy. It's a diversion, but it's a Portillo's story. So all of our Chicago listeners, you and I included,
no,
know
which
what
Portillo's is.
Portillo's is. We have a little history there. And he had let's say a 4 to 8,000 square foot retail spot with a drive-through. And I'm like, dude, you need to get Portillo's there. I was like texting him. He didn't even reply to the text. I'm like, he just must not know like what Portillo's is. And they got bought and they're going all over the country. It would be a
Yeah.
phenomenal tenant, right, in your
Yeah.
retail spot. Like that's kind of what you want. But he didn't recognize it.
They're the highest grossing non-fast casual restaurant in the United States per location. I think it's 8 or 9 million per location revenue per.
Wow. Yeah, it's phenomenal. Cool. Let's walk through this deal. Let's pretend that I am gonna invest $250,000 so that this is kind of real. I'm putting 250 grand in here, and some of the questions I'm gonna have up front, Jonathan, are gonna be like, what's the cost to build? What's the cost to build, including all the soft costs and the land, so like my actual cost basis. What is my rent per square foot? And do I have any pre-leasing going on? That would probably be where I would start as a first look to analyze the risk on the deal.
Sure. Yeah, I mean, I can actually pull it up because it's a lot of. We just start pre-leasing. We do have the top leasing broker, and that's with like to the market. This is off the top of my head without giving other details, but uh, it's the top leasing agent in that market. That's all he does is flex space and industrial, and in around Austin and San Antonio. The total, but I can break it down here. Let's see. Go through my OM here so I have exact data. Um, and and the cool thing about this deal too, it's with the flex space, or I'll say like for our numbers, for example, are very conservative. We have a 22 projected IRR, 12, and that's very conservative. Like we actually, and that was at I think a 19 lease. The market's actually gone up since we've done it, just without.
That's at $19 a foot triple
Yeah,
net.
yeah. And the market's actually the market dynamics because of all the new development coming in and interest, the leasing, like the leasing agent, I think we're gonna list it at 20. So, but I don't even have the actual financial modeling of that because it's just something I found out like an hour ago. What else I say? And then it's also a 12 pref with an 80-20 split. So it's very, very generous towards the investors because we want to make sure the investors, we have a bunch of deals in the pipeline. We're also looking at data centers, and we also have a second project which is 100,000 square feet that's already uh, fully funded, and that's going to be a medical office. One of our partners actually already own the land. So, but the soft cost, like, so let me look at the breakdown here. Let's see. The 10.7 acres will be acquired for 2.719 with nearly 1 million equity already secured through a favorable deal. And actually it's gone up because we've just seen the market's dynamics. The soft cost, we have about 2.468832. Construction, to your question about construction, we have it at 10,254,397. And then of course the land at 2.719. We have our GC that on our team is very seasoned. He's built a lot of the Walmarts in the area, and also some self storage as well. So, and the other partner on the team is he actually flipped the land across, but he did it early across from the Giga Center, the Tesla Giga Center. And I mean, like if he would have kept it a little longer, he saw the poor side of it, but he's been really favorable getting or finding favorable deals because he's been boots in the ground. It's his market, and so the one things that we've been really that really makes us stand out is we actually have a seasoned team that all have their expert skill sets. And we're able to source some of these deals that most people wouldn't have access to because they've been in this market for 5, 10 years before anybody else is even there.
Gotcha. So you don't really have your costs broken down on a per foot basis, it sounds like?
I'm gonna have to look at it 'cause we just did some financial modeling and we just got the new OM actually this morning. So per square foot, 250, on the exit and the pro forma, we have a 251, but on the pre, which comes out of 21, a little over 21 million, but on the per cost,
And that's the all-in cost basis at
no,
250?
that's the exit. Let me see what I have here.
Okay.
I don't have it because we just changed the numbers on it because we just have better financially now. I don't have
Yeah.
the full financial breakdown without, because I don't want to quote the wrong number, but and we're keeping that in that GC in-house. So like even our cost and even with the different tariffs and stuff like that, we have favorable acquisition costs of like just supplies. So.
Okay. Do you guys already have the construction loan lined up? We're working on a deal now, and the construction loan pushed by like 6 months, and I'm like, yeah, that's not really what we were hoping for, That's going to impact our returns at the end of the day.
Yeah. No, we're looking, yeah, we're due to close the initial tranche on 1.5. It's due October 1st. And then the total for developments it's due January, I think January 1st.
When you say total for development, what does that actually mean?
Well, the total what the bank needs. So yeah.
So meaning you have to have all of your equity raised by that date,
Yeah.
or
Yeah.
okay. Gotcha. And when is that wire due then from an investor who's interested in this deal today?
Yeah, so we're trying to wrap up this. We've been just really just kind of solidifying because we're also looking for long-term partners too. But we're trying to have everything solidified in the next 3 or 4 weeks here. We have right now we have the conference, the IMN conference in Nashville. We have probably like 5 or 10 family offices that are considering it right now because we do a lot of the family office conferences. Um, and so we're just trying to solidify the last few that are just going to like hopefully dial in here in the next week or two or 3 weeks. That's kind of like we're expected for the initial tranche. And then after that, I think it's going to be a pretty smooth sailing because we have so many other
So
different
if
conferences.
if you commit today, the wire is due in 3 weeks, or the wire is due on January 1st, or the wire is due on October 1st.
Yeah, before October 1st, sooner better, because we want to get
Okay.
everyone yeah, because you always have those some people that will sit there and say, oh yeah, and then they keep
Never,
pushing it.
yeah, they flake, yeah. So what do you
And
do?
you're
You
trying to
guys
figure out
run,
who are they coming in through. Yeah, but then get the initial 1.5, and we're at 1 million right now. So I think the last five, by the time this plays, it probably will be
will
full
be
because we
filled.
actually have calls, yeah, right, actually the next day and two.
What is there a pref on there? So like people are getting any
Not
kind
on
of
the
pref?
initial, no, not
No.
no. It's mostly yeah, it's with the whole the focus of it is basically about the 12th month is when we figure everything will should be start going getting done, and 18 months should be leased out.
Gotcha. Yeah, but I mean a preferred return for the investors. No preferred return. It's just kind of like
It
how the
was
deal.
12 pref, but I don't know exactly. I have to see like the breakdown when it actually starts. I don't. Alec would know that better than I would because I don't have that. Actually, Alec handles
Gotcha.
it.
All right, cool. Any depreciation benefits on a deal like this?
Well, the new big bill, I know they just changed, they solidified putting everything back in. So with the bonus depreciation, we haven't talked to the accountant yet to see exactly what that entails. I know it's getting down to what, 60% or 40% next year. I don't know exactly what depreciation we would qualify for because without having like a cost seg on it.
Yeah, it makes sense. Yeah, we're back to 100% now. So
Is it
we're all,
100%? Okay.
yeah, we're
Yeah.
all celebrating. Who people, those of us who write large checks and get tax benefits for doing so are celebrating for sure.
And it's officially where I passed everything.
That's done. Yep,
Oh,
100%
wow.
done.
Okay.
Yep.
I knew it
Yeah.
was like they were talking about it. I didn't know it already passed. Okay, cool.
Oh yeah. Yeah, so that works. Which I guess, on a 2-year exit, that doesn't really,
Make
I
much
mean,
difference. Yeah.
yeah, yeah, it's like 22. What kind of risk do you think is involved in this condo situation if you were hoping for an institutional exit? Like, do institutions actually buy flex condo spaces?
Well, the location's what sells it. And so the visibility, and I think that the play could be a redevelopment play in like 3 to 5 years. So just because of like it's on I-35, it's like the fastest growing corridor, and like the big retailers and national tenants are coming in right next door. So the big play is probably somebody, first it's going to be the tenant owner. It's going to, get loan for that and buy it out. And or the institutional play is going to come in and say, hey, we want to do this. We'll buy out the leases. Here's some money to move. We're going to tear this down and put something bigger here.
Yeah, but you've given them all first right of refusal, so that makes you've now handcuffed that institutional buyer when they come in to do that. You make it a lot harder, right? That's what I mean by the risk.
Well, I mean, they could come in and pay out the tenants though.
Yeah. Or they could pay you out at a higher price if you just used
Yeah.
straight leases on day one. Then you don't have to
Yeah, I mean,
negotiate.
the big thing
Yeah.
is the tenants. Well, the first one we're going to go to is the tenants, but like I think the bigger play is even the tenants could join together and say, "Hey, we're going to sell this to the like the play is like 4 or 5 years because the location's so prime is to basically tear it down. It's like with mobile home parks when they basically, yeah, cash flows and the location's great, but if you go to Florida, a lot of the parks are tearing down for senior healthcare centers and things of that nature because it's way more better, higher use for rents at that instead of a $500 lot rent.
Yeah, it makes sense. I'd almost like the deal better if there was no lease option going on with the tenants. I feel like me as an investor getting out in 2 years is not really that attractive. If
Yeah.
if the area is redeveloping long term, it's going to be a much better deal in 5 years. I'd rather, invest in a deal that's going to have a refi to pay back a portion of that capital, and like those tenants get no first right of refusal. The tenants pay the market rent when the time comes, or they move out when the redevelopment occurs. That feels like a safer bet to me, but I'm not going to tell you how to run your business. I'm sure you guys are doing well. Cool. So what is the here's what we're dealing with right now. You had alluded to it in some of the posts that you had put online, I think LinkedIn articles, things of that nature. It's kind of the consensus around these conferences in these events in commercial real estate space. But, we looked at multifamily, from 2011 through like 19, 2020, multifamily had this institutionalizing of the asset class. I mean, it was already, but we really saw that happen a lot, and the cap rates go down, and the values go up, and the competition for product gets superheated, right? Then we saw that same kind of thing going on in self storage from 2015 or so all the way up through 2022 when the stock prices for public storage and extra space dropped. A lot of that institutional frothiness and self storage had gone away, but it became super heated to get your hands on product for self storage. You described the same thing happening in the mobile home space,
Mhm.
and we expect, I think all of us, that we're in this little opportunity for flex space now. Maybe that is, 2, 3, 5 years. And there are some humongous portfolios for flex space trading in the headlines in the news. 190 million, 300 million, 150 million. Like these are big institutional deals in the flex space that are happening. Are you guys still seeing some mobile home park deal flow coming through for you guys, or is it kind of like, the parks you have are good and it's become much more difficult to get deal flow in the mobile home community space?
Yeah, that's kind of the general sentiment with most like when you go to the conferences. I know a lot of operators that would normally acquire 5 to 8 parks a year in the last couple of years, especially when the interest rates changed in 23, went down to like 1, 2 deals a year. It's a multitude of factors. You have the interest rates, so then you also have the sellers, which you mentioned before the call. The sellers have this mindset like, hey, this is what I was getting 3 years ago, but it doesn't even make financial sense. And so those parks that didn't sell, the owner wants to go back to those mindset prices that they had a couple years ago. And then plus there's only 43, 44,000 parks in the country. So approximately, and very few are ground up developments because of zoning stipulations. And then, like I mentioned before, some of the best ones, especially well, the Florida locations are some of the best prime locations, but the lots are tiny, so you can't even put newer modern homes on it because they're
Mm.
pre-HUD, pre-1976. So the lots are like a third the size they should be. They're basically like tiny homes. They'd be better reconverted into like a tiny home community, but the locations like you'll have like ocean or what not ocean, but waterfront properties like in Tampa. There are mobile home parks before the zoning came around, and then so like what they're doing is a lot of them is what can we tear it down to? The cities will give you like what is the best. They'll give you basically what zoning you want if it's going to be the highest and best. And so you see a lot of, like I mentioned, would be senior healthcare, memory care, senior healthcare centers, and those are very expensive and just in like the cash flow for even their operator because you're getting, a luxury senior healthcare one tenant could be paying $6,000 to $8,000 a month compared to $500 lot rent or 1,000 if it was a really nice market. So even for the developer side, it's a lot more advantageous to do that. But to your question, yeah, it's hard to find deals. So, the percentage of the deals are going to be institutional quality, anything over like 15, 20 million. Institutional operators will bid you down. You can't compete with them. They have better access to capital. And they get the rates and they just, they have billions of just in the tens of billions in that asset class. And so it's just rolling it up to their, in their portfolio. And then there's also the percentage that goes to that the whole mobile home park, the trailer, what you want to call it. There's 20%, I don't know what approximately what that is, but there's a percentage of parks like that, are gravel roads, they're not going to qualify for HUD financing. It's going to be a complete turnaround project. And then you have the biggest challenge for doing a turnaround project is sourcing new homes. And so you have Warren Buffett has the 21st program. So basically, he has Clayton Homes. He's the biggest manufacturer, 50,000 plus homes a year out of 100,000 mobile homes. And then he also has the biggest financier, and they have a program to push the homes. But then you're just developing a subdivision at that point to get $500 lot rent. And so, yeah, you make some money on the homes, but again, it comes back to highest and best use of your capital.
Yeah,
So,
and it gets your
but the
time too, right? At that
yeah,
point.
exactly. You could do all, yeah, you could say, hey, we got this great return, but it's going to be, you're going to be so boots in the ground, indebted with like, you could do three projects for the same time amount of work you do in a mobile home park. So mobile home parks is probably the biggest misconception to this whole point is it just turnkey, but to get it turnkey, unless it's like a class A, like a top tier property professionally property managed for the last 5, 10 years and system rules and everything's digital, 90% of parks aren't like that. And so you have to basically convert everything from like 1970s, 80s, payments going to like different local banks. People don't even pay online. They don't even use online. It's not like multifamily, even class C multifamily. So you're basically doing a full turnaround. And so I think a lot of those deals that were attractive have been all acquired and people are just holding on to them for forever, basically.
Yeah, I own one with some partners in New Hampshire, and it's kind of out there. It's not in like it is not a Tampa type of highly developed area. We're not doing a land banking kind of a thing. But the roads were done, and it is turnkey, and it's like a hands-off kind of an asset, and that's like a coupon clipper for us. And it was well managed, and it was bought originally as a turnaround by the previous partnership. I don't know, 3 or 4 or 5 years ago, something like maybe we have 80 or 90 homes, if I had to guess. None of them are brand new Clayton homes. We may add like 9 lots, but this is not the kind of deal. Like, we're not raising money for this. This is not going to have an 18 or a 20 or a 22 IRR. It's something we're going to hang on to at least for a decade. I think our debt instrument on that one is a 10-year, like we can't get
Nice.
out for 10 years, and that's why we got an okay interest rate on the way in, all things considered. But we're going to look back in 3, 4, 5 years and be like, man, that interest rate's high and we're stuck and our hands are tied by the interest rate. But again, our motivation is a little bit different. We're going to be there for 10 years. There were great tax benefits for the partners on the way in, and then it's kind of a cash flow. I mean, it wasn't day one, but maybe day 120 or so. It was like now all of a sudden it's just a coupon, right?
Yeah.
But that's not the kind of deal that, a guy like yourself or the people who are running the funds are going to be able to go out and do. It's not really a capital preservation, coupon clipping kind of a strategy. It's more of an entrepreneurial operator slash real estate developer strategy where there is going to be a lot more of a heavy lift than I'm putting into that mobile home park for you to bring the flex building in Texas out of the ground and get it stabilized and go through the entire process of executing on that.
Yeah, it's a lot faster. And then to your point, yeah, it's with the mobile home park space, it's like the mindset, like you have to have that mindset. Like the value is a 7, 10 year hold. Like it's not a multifamily 3 to 5 cash out. I mean, you can cash out refi, but it's to keep it long term. And so like some people, the institutional buyers for investors, for example, like the family office, they majority invest, like whoever knows the exact number, but 70 plus invest in multifamily. And when they kind of explore into the mobile home park space, for example, they're like, okay, these deals aren't big enough. Well, we need this, they have this certain criteria. The fund needs to be like 50, 100 million. That's why there's not any really park funds that are because they can't source enough deals. And the size of the
Mm.
deals, like a $15 million mobile home park is like a $60 million, like approximate equivalent, like if you're acquiring a multifamily deal. And so it sounds great for them and they like the bigger numbers, but like in the realm of what we're competing at, it's a two different worlds. And so a lot of the institutional money besides the private equity, the Blackstones, the Apollo groups, the family office have been sitting on the sidelines on a lot of these deals because they just don't understand the nuances and the opportunity. And they're usually, which is unusual because family office is their whole premise is keeping the money, generational wealth, and preserving the wealth. Well, what's the number one performing asset for the last 50 years has been mobile home parks, the lowest failure rate, like you mentioned, the best tax benefits. It's a tried and true way, and it's just preserving wealth. If you already have a capital, just put it in there and just acquire some small parks until it meets your portfolio standards. And so I think a lot of family offices have dropped the ball in that, understanding where the real value is, because that's the real value of mobile home parks, because it's the cheapest form of affordable housing.
Yeah, at the same time, I mean, the institutions do need to scale. I think we had a 300 lot deal a few months back, maybe a year ago now. And our offer was 13.5 million. And I think they traded at like 24, 25 million. So we're talking like four and a half, 5 cap. is
Yeah.
what it traded at on its current income,
They'll
and
buy, they'll buy you, they'll bid you out. That's
it was
basically what
nuts.
happens.
It was
Small
even
operators.
rent controlled. It was like a rent controlled area where it was going to be a big hassle to try to bring anybody up to market rent. So, yeah, we see firsthand the competition that's out there. 80, 60 lot. We did get, I think, one or two that were 150, 200 space maybe last year, again, with some partners. And those were big projects, right? Those were kind of the ones where a lot of old homes, a lot of 1980s payments, and a big mess to clean up. A lot of
Yeah,
work.
it's not easy. That's what
Yeah.
people think. They get sold on it's like this turnkey, but once you get it there and you have the proper management, but I still think parks will be all like one of my favorite asset classes of all time. You just got to go. If you look at all the other funds and operators, they all have multiple asset classes because of that reason. Like Bear Brandon, he started doing multifamily. I think he did self-storage, and like a couple of my other friends started doing self-storage and other asset classes, parking lots. Some guys started doing parking lots. So. It's just mainly because there's just a scarcity or availability of the park assets. And to your point with the being bid down, the institutional, if it's anything in the teens, that's when they start coming in because they're trying to scoop up these deals and roll them up. Like I said, they're cost acquired, so they're not even getting this nice great return because they already know what the value is, and they basically bid you out. It's crazy. We had one deal, for example, it was off market. There's three bidders. They wouldn't tell us who it was. It was a family-owned operator. I had a broker relationship with the broker who was really pushing us, and we had one investor because they were like want to make sure we have. My one investor had 30 million cash in the bank. I couldn't even believe it. I mean, like, who has that? He didn't have like about $80 million in multifamily deals, but I was like, who has $30 million in your bank account? That's like crazy. So they're
That
like, okay, it's
works. It's
just,
not a bad
yeah,
thing.
just to solidify, like when they said we're only gonna take three offers, and just to show that you have the cash, and then like they wanted to see the story, so like, oh, we like you're a small rapper, but you have access to capital, and you're like up and coming, so we like that. And they didn't tell us who the two bidders would be. And I told the investor, I'm like, we need to come in at like a 25 million. Like this is like we can't scoop it up. He's like, well, let's come in kind of like the same thing. He's like, let's come in at like 21, 22. We could scoop it up. I'm like, there's no way. At the time, the average lot were trading at 48,000. I'm like, we gotta come at least what the average lot is trading in America because it was a college town,
Mm.
and it was a major college university. I don't want to give out too many details, but the cool thing about it was like waiting list for years because cool place for the college kids to hang out. The parents would buy the homes. They're set, 80s, 70s, 80s, 90s home stock. And so they would just like it just basically they know they had a safe place and they could flip the homes because there's a waiting list and they'd still make a few grand on the flipping it. And then the park had all these amenities, had like game room, arcade, pool, basketball court, I think even a tennis court. And so it was just like the cool spot for people, like college kids to hang out. But and long story short was I said we should came at 26. We came in at 22.5 or something. I was just like, I was embarrassed to even submit it to the broker. He's like, no, they just kind of looked at it and threw it away. I was like, I know, I told him we should have came in. And then I'm like, waited a month. I'm like, what did it sell for? 26.2. I was like, I knew it, but the whole point, it was like it would trade in like a four something cap. But the play was, it was just gonna just cash flow. You weren't gonna make much on the equity side of it.
Yeah. I don't know. No need to do a deal just to do a deal either.
Yeah, yeah. So like, and then
Yeah.
then the investor basically, he's like, I'm sticking to multifamily. I don't like this class.
Yeah, that's fair. There's some
Yeah, he's like,
opportunity out there,
this is too
right?
complex for me. I don't like. He didn't say that. But he's just like, this is just like, I like the returns better on multifamily. So,
Yeah, yeah. I mean, if you know the space and you know the space, so what has you excited? We're August 2025. Um, the day we're recording today, our hopes were dashed a little bit about interest rate drops. So interest
yeah.
rate aside, what are you excited about in the future here? Next 12, 24 months, Jonathan, what are you looking forward to?
Well, besides flex space, I think the big opportunities would be data centers. I think the next 5 to 10 years, that's kind of like the long-term play we're looking at. We're looking at very sub niche of that because the big going instead of the PE, like the private equity guys, on the other world, you have the tech guys, and you have, I don't know if people read recently, but Mark Zuckerberg's building a data center the size of Manhattan. I don't forget where he's at, but it's with everything going AI, everyone's on their phones, the amount of data usage is going to skyrocket. And so we think that the opportunity is going to be finding abandoned like office buildings where the cities want the tax revenue because they're not collecting revenue on it. It's an eyesore where they already have the power and reconverting that in, and we're still underneath the institutional. So we're trying to find a niche where it serves. And then also it's a lot better than developing because you actually have, I mean, you're still doing a, reconvert, but you still have a lot of the infrastructure, and then you get like the city is going to work with you because
So what
of
was it you were going to convert?
office buildings that already have the
Oh,
power,
got you, got you.
like abandoned office buildings. And
Yeah, yeah. The issue they're having with that on the conversions, we did a podcast actually with the designer a little while back on the data centers. Um, the racks don't fit. You need like 24-foot clear height to fit the lower rack and the upper
okay.
rack that have liquid cooling in them now. So like you remember like engines back in the day used to have fins on them. I remember like dirt bikes in the 80s when I grew up and they'd have like the fins. There was no radiator there, right? That's how engines were. They were air cooled. And that's how the data center racks used to be before they've gotten as powerful as they are now. And the same way engines now have this radiator and the hose, and it's like pumping the liquid around. Now the computer equipment has that kind of um, cooling system technology in it for them to be competitive. So if you end up building something that doesn't have that cooling, you're going to have a hard time keeping those racks leased out to the tech. Yeah. So like we looked
Yeah.
at the office buildings too for kind of the same thing. If you find one, I think it was like, I forget it was like the exact number, 16, 18, 20 feet. It was really high. And that was what was disqualifying a lot of the office buildings from the data center conversion. It's kind of,
Yeah, we're researching. We're bringing on teams that's doing it. We have a couple of family offices that are looking at it back. They're bigger deals. They're like 100 million plus. It's the same premise what people are doing the retail centers into self-storage and what the height you need about the 17, 18 foot ceiling clearance for the a
same
lot of
deal.
people. Yeah, same premise from converting the retail into self-storage. It's like so yeah, it's and I mean those are we're just getting in exploring in that niche right now and doing boots in the ground research on that. But I think that's the big play. I think with AI and technology, I like to say ahead of trends. 'Cause it just reminds me of when I first got into commercial real estate back and mobile home parks back then. It's like what's new, what's going to have the longevity trends, and those are the two niches I think that are most exciting right now.
I love it. I love it. Are there any books that you've read recently, or maybe books that you've recommended to other people? Maybe in line with some of the stuff we talked about today, maybe just, wealth creation business in general?
I would say if we're doing real estate, you got to go with the classic. And we're Chicago, and so I used to be, but Sam Zell, even though he passed away recently, a couple years ago now, but I think his mindset and how you look at real estate, look at opportunities in real estate, and he was always real big on the trends and identifying opportunities and getting out before the trends changed.
Yeah, it's same. What was that book called? Not
Oh,
Wealth
what was it called?
Creation.
Never, man, I forgot. I just know it's Sam
Am
Zell.
I being too subtle?
Subtle, yeah, it might be into subtle. I haven't
Yep.
read it in like 3 years, but yeah,
Yeah, it
I
came
used
out. It
to.
was huge, at least for all of us in Chicago. We all know Sam Zell's name here in Chicago. It was interesting. So on that book, it's good on an audio book too.
Mhm.
Sam Zell sells equity office properties in like 2007 or 2008. So literally the
Yeah.
peak is sort of in the rear view. Everyone knows shit is literally flying through the air to hit the fan in the moment that he's selling these office buildings, and he's selling them to Blackstone. Um, and Blackstone is buying them and gets the deal closed. They go to settlement. So you can hear both sides of that deal go down. One in Am I Being Too Subtle from Sam's perspective, and then you hear it from Steve Schwartzman's perspective in what it takes, the story of Blackstone's founding. But that's the biggest wholesale deal that has gone down in history. I think it was a $50 billion deal altogether, and roughly half, so around $25 billion worth of the uh, most trophy office buildings in the country, maybe the world, were sold on the same day they were bought from Sam Zell, which is like pretty fucking cool.
Yeah, he was yeah, just an innovator. He was at one point, I think, the biggest owner of office buildings, biggest owner of mobile home parks, and the biggest owner of multifamily. And now I think he still has, I don't know exactly what his family office is doing now, but last I heard, and this was like 3 years ago, but I think he was selling portion of his multifamily and keeping the Class A stuff. And he was keeping the stuff, I think the Colorados, and he was acquiring more mobile home parks and RV parks. So that just kind of reiterates, you know what his positioning was. And I remember like he was I was gonna go to a family office guy. I was in Chicago I was flying back in for it, and it was like he was going to be one of the keynote speakers. And like he passed away like a month before. I'm like, oh, I'm not paying $3,000 to go to this conference now. He's not
Wow.
there. And I'm sure they probably had a huge drop off because I was
Yeah,
like,
they did. Half the seats are empty.
yeah, I was like, well, that was the whole premise of me going there. Like he's not there. I don't want to go.
Yeah,
So,
and you were coming from halfway around the world, I guess, at
yeah,
that time
exactly.
too,
So
right?
it was
Yeah.
a long flight.
That's cool. That's cool. So where can listeners go? Do you want to share a website or some contact information, Jonathan?
Sure. Yeah, for the manufactured housing, or actually LinkedIn, Jonathan Tuttle one, the number one. Um, I'm I'm not too active on there, but a lot of people message me on there. I just noticed I have like 10 messages that I haven't responded to. But LinkedIn, or then land-play is the self-storage, or not self-storage, flex space. It got me some self-storage. We actually will have a potential self-storage deal too, but um, and then also Midwest Park Capital is the mobile home park fund, but those are one-off deals with the Midwest Park Capital. So we're just looking for just opportunities that, hopefully I find something this next week when I'm in Nashville at the IMN conference. So there's a lot of the big operators. We're all pretty good friends. So maybe we'll score some deals off market here.
Nice, nice.
Um,
Sounds like a plan. So my final question I ask all the guests is, what is the kindest thing that anyone has ever done for you?
Man, the kindest thing. I would say it's probably my mom. My mom's always been my backbone. She's always the one, no matter what. She's always there looking out and just helping. I don't think anybody else could top that because she's always there for me.
Yeah, nothing like our parents, huh? They made
Yep.
quite a sacrifice for a hell of a long time to get us to where we're at today.
Yep, exactly.
All right, Jonathan, I got pages of notes here. I appreciate you coming on the show.
Yeah, thanks for having me on. It was good, great to be on.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.